The views and opinions expressed on the following program are not necessarily those of the staff and management of Salem Media of Hawaii.
Welcome to Hawaii Money Resource with financial advisor Marko Mijuskovic.
Marko Mijuskovic is registered representative and financial advisor of Park Avenue Securities LLC, 7 Hanover Square, New York, 10004, and at Wealth Strategy Partners, 677 Ala Moana Boulevard, Suite 720, Honolulu, Hawaii, 96813. This show is for informational purposes only. Individual risk tolerance and investment objectives must be reviewed prior to making any specific recommendations.
And now your host, Marko Mijuskovic.
Welcome back. You're listening to Hawaii Money Resource. My name is Marko Mijuskovic, senior partner at Certified Exit Planner at Wealth Strategy Partners. Also, every Wednesday night, 5 to 6 p.m., we are here on the radio talking to you, try to educate you as much as we can. Share the knowledge, share the wealth of knowledge that we have with you, and hopefully some of this stuff will stick with you and you will improve yourself as a business owner as well as a person. So what we do here at Hawaii Money Resource every Wednesday at 5 to 6 p.m., we try to talk to business. We try to, if you're a business owner, we try to educate you on the scoops, how to run the business, so one day you can get out of that business in style. And isn't that every business owner dream? Let's work hard for these 5, 10, 15, 20, 30 years, and eventually I'm going to get out of this business. I'm going to sell my business, transfer this business, and I'm going to pocket so much money that I'm going to enjoy the rest of my life. So if you're a business owner, that's what we're going to talk about in our radio show. If you're just a regular person and you're not happy with your life, we cannot help you. Just kidding. For you, we will try to encourage you, so maybe you will start your own business. Maybe you will quit your day job that you're really miserable waking up every morning and going to, and you will maybe start your own adventure. Maybe you will go to the CCA website and register your company and do that stuff or your hobby or whatever you like to do and try to turn that into the business. So, well, if you're listening to our radio show, we interview since 2011 probably over 400 different guests, different business owners, people from the different type of businesses, different level of businesses, different industries, and you probably can get a pretty good picture by listening to these people that how did they start it, what it takes for you to be entrepreneur, business owner, scoops and hurdles that they're dealing with, and you can at least prepare yourself best possible way that you can. But don't forget, the life of the business owner is unpredictable. You never know what might happen. Always prepare, always plan for the worst case scenario. So if something better happens, guess what? You're going to do well. Anyway, when we do have a guest, we interview the guest. We try to pick their brain for 1 hour. When we don't have a guest, we talk about a business exit and business exit planning. And today, we do have a business exit planning edition of Hawaii Money Resource. As you can see, lately, more and more shows are focusing on business exit planning. Why? Just because we have more and more people in need for this topic to be covered as much as can possibly cover, because people are just generally confused. They don't know where to go, who to talk to, what to do. They just think that they're going to find a business broker and try to sell their business, but that's actually a pretty big mistake. Yeah, it might happen, but what will be the consequences and what will be the price of doing that and not preparing ahead of time? So today we're going to talk about a cash flow. Today's topic is a cash flow, exit planning and cash flow. We're going to talk about importance of cash flow and overall planning. But before we go and dive into that, let me remind you of two things. First, HawaiiMoneyResource.com. HawaiiMoneyResource.com is a website for our radio show. Second, BusinessExitPlanningHawaii.com. BusinessExitPlanningHawaii.com is the website for business exit planning and preparation for departure out of that business. You can find a lot of good stuff. First of all, you can see the four type of services that we are focusing on when we are talking to the business owner for exit planning. And those are the business exit, business valuation, asset protection, and estate planning. Four very, very, very important components of any business exit and overall planning. then you can find a lot of resources on our website. And those resources are a lot of good white papers, articles, press releases, videos, and much, much more to come. Just for you to know, you can subscribe to our newsletters and pretty much be informed every time when the information comes on the websites. And you can definitely talk to us, because we have a section that you can schedule your meeting with us in the office and pick our brain for an hour and just brainstorming to see where you at and where you should go when it comes to the business and business exit planning. So businessexitplanninghawaii.com, businessexitplanninghawaii.com. If you're old-fashioned and you like the phone, you can call us at 695-2102, 808-695-2102. Okay, so let's dive in today's topic, exit planning and the cash flow. Importance of cash flow is huge, especially when you are considering internal transfer. So it's not uncommon for business owners to ask their advisors, based on conversation they had with other owners, do you think I can get 6 times multiple for my company? And when someone is asking you that, or if you're a business owner asking that, what is the expected answer? Well, if you're asking us that question right out of the bat and says, hey, Marko, what do you think? Can I get for my XYZ business 6 times multiple of my EBITDA? I'll tell you, you know what? I really don't know, or neither that I can answer that question. Why? Because is very, I'll say very depends on, what's going on with your business. And as well, what type of business you're running and in what industry. So cash is a king is a favorite phrase for investment bankers, since the certainty of the future cash from seller business can minimize the buyer risk in transaction. Buyers, however, make a slight variation on the phrase cash flow is a king. Why? Few cash buyers are willing to part with their money unless they see the likelihood of steadily increasing stream of cash flowing from the business and then after they acquire the company. So business banker like cash is a king, buyers like cash flow is the king. For that reason, this what we're going to be covering today is exploring the definition and importance of cash flow when selling a business to financial buyer, the most common type of buyer. So are you ready? If you are, let's dive into it. So cash flow, today's financial buyers are both anxious and selective about acquiring companies. They need to deploy the capital they raise from investors or return it. At the same time, they are using less financing to acquire companies and more of their own capital. They can't afford to make costly mistakes. They see companies that have increasing cash flow, good growth potential, and strong fundamentals, such as strong management team and good operating systems. Of course, this characteristic has always been important signs of a good company, but given the fact that buyers are reaching into their own wallets for 50% or more of a purchase price, minimizing risk by basing their acquisition on a strong company cash flow has never been more crucial than it is nowadays. So cash flow and the risk. Acquiring a business with strong cash flow reduces buyers' risk in transaction. Therefore, for many owners, sellers, the chance to receive maximum price for their companies depends on current and future cash flow. It's a cash flow often described as EBITDA that truly is a king. While most owners are familiar with the term EBITDA, that doesn't mean that they understand or use it in the same manner as a professional buyer do. So what is the definition of the cash flow? There are several definitions of measures of cash flow, each with a potential significant and substantive difference. For that reason, investment bankers will agree with the seller that they can get any multiple of cash flow sellers ask for as long as they let them define the cash flow. The devil truly is in the details, or in this case, in definition. Typical measures of cash flow include earnings before interest and taxes, so-called EBITDA or EBIT. And EBITDA, another measure of cash flow, is the amount of pre-tax money actually distributed to owners via salary, bonus, and distribution from companies such as distribution and rental payment in excess of fair market rental value of the equipment or building used in the business. So what is this mumbo jumbo means to you? Well, in simple terms, if we are looking at really what is the EBITDA to your business, we need to take in consideration all of your, first of all, net profit, but we need to add to that all the salaries, all the rents, all the other money that is paid to the owner in excess of that net income. And I usually like to say, since we are not CPAs, go talk to your CPA and they will be more than happy to explain this into the details. Each of these measures of cash flow produce a different cash flow amount. Once the parties agree on how to measure cash flow, don't forget the seller need to recast cash flow by adding back items such as excess rent, excess salary, bonus paid to the owners and his or her family. So Richard, bring us back to our original question. Do you think I can get 6 times multiple for my company? The question the business owner usually asks. We suggest you to respond should be first to ask questions that enable you to understand what owners believe that they are multiplying. So if you are the owner and you ask this question, you need to ask yourself, okay, what am I multiplying over here? The message for those of us who are exit planning advisors but do not work with M&A is make certain that owner clients share with us the definition of cash flow and related terms such as EBITDA. Equal importance is asking the investment banker or business broker on our team to review a client's financial information and determine EBITDA or EBIT and cash flow in the same way as buyers do. Only then it's possible for us in a team to lead and develop the range of different sales prices that potential seller will like. A major objective is in this second step of the business exit planning is develop accurate information regarding you as a business owner and your financial resources rather than relying on your opinion. If you know your starting point as a business owner, it's fundamental to develop an accurate roadmap. And we talked about in one of our previous shows, what is the roadmap? What is it that you need to set up first? How to set up your goals? How to set up the exit days? And all these important things that you should consider as a business owner. I'm getting more and more answers from the owner when I ask him, when do you want to get out? Well, soon, 3, 5, 10 years. But they never put the actual year of that exit. Why don't we take our first break? Today's topic for a business exit planning edition of Hawaii Money Resource is exit planning and a cash flow. So stay tuned. My name is Marko Mijuskovic. You're listening business exit planning edition of Hawaii Money Resource. Don't forget to download the podcast. It's going to be up shortly at hawaiimoneyresource.com or businessexitplanninghawaii.com. Stay tuned. We'll be right back.
KGU,
part of the Wall Street Business Network.
You've gone to protests, written letters, even considered chaining yourself to a tree. But saving the world is not easy at all. Fortunately, saving a life is. And when you donate 1 pint of blood, you can save up to 3 lives. Visit bloodsaves.com to learn more.
Once upon a time, there was a business owner who worked hard and watched his company flourish. Then came the time to sell his company and retire in Palm Beach. But the path to his happily ever after was full of pitfalls and monstrous taxes. Whatever was he to do?
It's not a fairy tale, and the wrong strategy can deprive you of a storybook ending. I'm Marko Mijuskovic, and I know about business valuation. I'm also a specialist in business exit, asset protection, and estate planning. visit my website, businessexitplanninghawaii.com, and I promise you'll find more than just a trail of breadcrumbs.
BusinessExitPlanningHawaii.com is an online resource designed to help you prepare for the final stage of your business's life cycle. At BusinessExitPlanningHawaii.com, you'll have no trouble at all finding workshops, podcasts, videos, articles, and more. Your happily ever after is just a click away at BusinessExitPlanningHawaii.com.
You're listening to Marko Mijuskovic on AM 760. More than 4,000 other listeners tune in daily to hear Marko talk about investment strategies and his new area of expertise, business exit planning. If you're ready to take it to the next level, Mr. Mijuskovic invites you to attend one of his complimentary seminars. Each month, he offers a seminar for business owners interested in business exit planning. For everybody else, he offers a second seminar on investment strategies. Either way, you'll get such a wealth of information that I'm going to attend one right now. For information on how you can attend, visit HawaiiMoneyResource.com. The lawyers can take it from here.
Registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 7 Hanover Square, New York, 10004, 1-888-600-4667. Securities products and advisory services offered through PAS member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America. Guardian, New York, New York. PAS is an indirect wholly owned subsidiary of Guardian. Wealth Strategy Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. 2014-16224, expiration 1/2017.
You're listening to Hawaii Money Resource with financial advisor Marko Mijuskovic. If you'd like to speak to Marko, either on the air or after the show, call toll-free from Oahu and the outer islands, 877-695-2102. That's 877-695-2102.
Welcome back. You're listening to Hawaii Money Resource. Today we have a business exit planning edition of Hawaii Money Resource, and the topic is exit planning and a cash flow. Why exit planning and a cash flow? What do we mean by that? Well, exit planning and a cash flow just in the whole process of exit planning is very, very important. So if you're running your business and there is no cash flow, the exit will be much harder than you think. So in a previous segment, we talked about a business exit planning and a cash flow in regards to the buying the business and buyer who are looking to buy the business, why they're looking to buy businesses with a positive cash flow or cash flow stream. Why? Because it helps them predict or helps them mitigate the risk of buying that business. When it comes to internal transfers, now we're talking about internal transfers versus external transfers. When you are financing internal transfer, that is usually doesn't have it's usually happening with no money down or with a lot of sweat equity down, how I like to call it. And when you're transferring the business to the key employee or family member, usually you're transferring that business without them putting any money down or cashing you right up front. So cash flow now as well is playing a very important role because that cash flow will finance this transfer, meaning that cash flow and future earnouts of the business will help you get the maximum money out of the business into your pocket. So when we are helping the business owner structure the deal of the internal transfer, cash flow is definitely very important. Important to the extent that if there is no cash flow, maybe we need to delay that process of transfer or be creative and look at your tax planning and tax minimizing strategies first, talking to the CPA, and looking how can we improve that cash flow first before we start with the process. Cash flow is very important too because that money that business produces eventually will end up in your personal pockets, meaning that will support your lifestyle going forward once that business is transferred. So financial gap or gap analysis is also part of the same exit planning step or step 2 when we are determining not only just the cash flow of your business, but at the same time we're determining what is the gap between your personal finances and your business value. Don't forget that gap. If that gap is wider, chances are slimmer. So let's talk about a business valuation a little bit more. Let's talk more about a financial gap. And how's the financial gap impacting the business owner's decision. So number 1 is the gap analysis that we do in a second step of business exit planning, 7-step process, the gap analysis establishes both an owner's starting and end points, and therefore enable us as a business exit planners to chart the path between the two. The gap analysis prompts most owners to undertake the planning necessary to go from where they are today to where they want to be when they exit their companies. So the gap calculation, how you calculate that. So let's assume that your business, or you as a business owner, financial independent goal is a requirement of investment capital of $5 million upon the exit, meaning the business owner needs $5 million once they leave the business. Why? Because we calculated that that is the amount to support their lifestyle for the remainder of their years. So if this business owner's available resources, including net proceeds from the transfer of the business, is totaling $3 million, her or his financial gap is $2 million. So the next phase of planning then involves creating and implementing series of recommendation to close that gap by the exit date this owner has selected. So the question we usually get, well, how do you know how much money the business will produce upon the sale? Well, that's why we do the valuation. So in the second part of this show, I'm going to circle back to the valuation question, and I'm going to talk about 5 reasons you need to know what your business is worth. A lot of time I get a lot of pushbacks from the business owners that they're saying, well, I don't want to do a business valuation right now, blah, blah, blah. But in reality, what they're trying to tell me, or what they're saying is, well, I don't want to pay $5,000 for someone to come and tell me what my business is worth. And they don't even operate in my business. So that's pretty much what the underlying message is. But it's very important, it's very necessary. So the gap discussion need to be started right up front in the conversation with the business owner. That discussion usually starts with the questions as like follows. In the financial security goal, you set if the financial security goal is accurate, and is it accurate or unrealistically low? So those are the questions that we ask in business owner. Have you quantified the resources, both business and personal, currently available to attain your financial security goal? Is there a shortfall, or how we call it, asset gap, between the resources you have and those you will need to achieve your financial security goal, Mr. Business Owner? If so, how great is the asset gap between the value of your current resources and resources you will need? And last question that we ask, what must you do to bring your asset gap down or to bridge that asset gap? So these questions that I just mentioned, and much more, are all part of the gap analysis. So business owners also ask us, what is the analysis benefit? What will be my gap analysis benefit? Well, the gap analysis serves 2 critical functions. First, establishing the start and end points of the owner's journey and providing the motivation many owners need to plan a route between those points. It also has several important benefits. Number 1, determining the size of the gap that owners must fill before it can exit successfully allows you and us, so it allows you as a business owner, us as a planner, to effectively and efficiently develop and execute strategies to close that gap. Learning that there is likely a greater financial shortfall than owners anticipate motivates most owners to increase business value and cash flow sooner and more forcefully than does remaining blissfully unaware of the work they need to do. This means you're able to engage into the process of business exit planning sooner. Number 3, conversely, learning that there is a little or no gap between where the business owner is right now and where they want to be enables the business owner to turn their attention to important exit planning endeavors, perhaps deciding whether they want to vacation home on a beach or in the mountain. What does this mean as well is if there is no gap, what you need and what the business is worth, maybe you can consider your exit sooner. The gap analysis gives the owners a new and more realistic understanding of how much time capital, and effort it will take to get from where they are to where they are right now to where they want to be in the future. Financial gap also comes with some misperceptions, and those are from our experience, few owners understand the need for gap analysis or what one involves. Compounding that problem is that few advisors that are working with the business owners have considered the importance of the first understanding, that then helping the owner clients analyzing the gap, and doing so would seem to be simple task, a straightforward undertaking. And it is, except for one small detail. Owner and all too often their advisors operate under a host of misperceptions. These misperceptions prevent most owners from successfully exiting their business. So for you, Mr. Business Owner, listening to our radio show, word of wisdom is stop working with assumptions, get into the dirt, figure out those numbers, look at your QuickBooks, P&L statements, look at your personal cash flow analysis, look at your personal assets, calculate everything, do your homework. Listen, you work all your life so hard to accumulate the assets, create the business out of nothing. Help the families of the employees in that whole process, and putting so much on risk in that whole process in the last 20, 30 years. I think that you can spend a little bit of time now on the end of this show, meaning your business career, to calculate a little bit into the details. What is my financial gap? Is not that hard, okay? Spend some time, and I'm telling you, even if you don't employ the advisors like us, even though you don't work with any financial advisors or whatever advisors out there that you can potentially work, do your job a little bit by yourself. Calculate it, figure it out, where you at, how much money you need in order to survive and live comfortably in the same lifestyle, in the same lifestyle level for next 20, 30 years, depends on your age. So, going back, today we covering a couple of topics, but the name of the show is Exit Planning and Cash Flow. We talk about the financial gaps. What are the financial gaps? We're going to be also talking about pretty soon about the business valuation. But before we check off, I want to remind you to go and visit our website, businessexitplanninghawaii.com, businessexitplanninghawaii.com. We're going to take another break, and then we're going to talk a little bit more about the gap, financial gap between the business and your personal, and then we're going to dive a little bit more into the business valuation. So stay tuned. You're listening to Hawaii Money Resource. Today we have Business Exit Planning, edition of Hawaii Money Resource. My name is Marko Mijuskovic. Stay tuned. We'll be right back.
.760 KGU.
Part of the Wall Street Business Network.
For America's wounded warriors, sometimes coming home can be a battle in itself. Every one of them needs our support to meet the challenges they face every day. The USO provides Americans a way to offer that support to our wounded warriors and their families. Join us. Visit USO.org to learn how you can make a difference in their lives. The USO.
Once upon a time, there was a business owner who worked hard and watched his company flourish. Then came the time to sell his company and retire in Palm Beach. But the path to his happily ever after was full of pitfalls and monstrous taxes. Whatever was he to do?
It's not a fairy tale, and the wrong strategy can deprive you of a storybook ending. I'm Marko Mijuskovic, and I know about business valuation. I'm also a specialist in business exit, asset protection, and estate planning. Visit my website, businessexitplanninghawaii.com, and I promise you'll find more than just a trail of breadcrumbs.
BusinessExitPlanningHawaii.com is an online resource designed to help you prepare for the final stage of your business's life cycle. At businessexitplanninghawaii.com, you'll have no trouble at all finding workshops, podcasts, videos, articles, and more. Your happily ever after is just a click away at businessexitplanninghawaii.com.
You're listening to Hawaii Money Resource with financial advisor Marko Mijuskovic. If you'd like to speak to Marko, either on the air or after the show, call toll-free from Oahu and the outer islands, 877-695-2102. That's 877-695-2102.
Welcome back. You're listening to Hawaii Money Resource. My name is Marko Mijuskovic, Senior Partner and also Certified Exit Planner. And you're listening Business Exit Planning edition of Hawaii Money Resource. Every Wednesday night, we have our radio show starting at 5 p.m. till 6 p.m. right when you're stuck in traffic and you're driving home. You can listen to our radio show and get a little bit more education when it comes to the business and business exit planning. I will say comfortably that nobody did provide more education here in Hawaii since 2011 on a business and business exit planning than Hawaii Money Resource of myself and our team. Well, before the show, before the break, we talk about a gap and gap analysis. We also talk about exit planning and a cash flow. By the way, today's topic is exit planning and cash flow. Why? Because we truly believe that it doesn't really matter what type of business you're running and what type of transfer you anticipated. Is it internal transfer to the employees or family members or external sales to the third party? Cash flow is crucial. Okay, now going back to gap analysis. What is gap analysis? Again, just quickly reminding you is a gap between or difference between what the value of the business is after you sell it and after taxes, and what did you accumulated on a personal level, and how much money do you actually need in order to sustain your lifestyle until later on, until you pass away. So let me give you an example. If the value of the business is $3 million and you're receiving $3 million after tax upon you sell your business, and you have maybe another $1 million accumulated in personal level, but you need $5 million to sustain your lifestyle going forward, that gives you like a negative $1 million. What does that mean for you? That means that you probably need to deploy certain strategies to increase the either value of your business and minimize the gap. A lot of time business owners really don't know where they operate and where they really stand. Why? Because they didn't take time to work on this issue. And a lot of times they were basing their opinions and their decisions on the opinions and assumptions. So let's talk a little bit about lack of knowledge. And why is the lack of knowledge so dangerous to business owners? Number one, the current value and growth rate of their business might be wrong, and they don't know. Maybe they just don't know what the current value is and what is the growth of their business. Number two, the future performance of their non-business assets. Maybe business owners are not really aware of it, or they never look into it. The amount of money they will spend in their post-exit lives. And like I always like to say, working with the people when they're retiring, approaching their retirement, I tell them, well, don't forget, once you retire, every day is a Saturday. And the last one, unfortunately, this one is really hard to predict or figure out, is the life expectancy. Typically, owners overestimate business value and future business growth. They're very bullish on investment performance and in denial about how much money they will spend in retirement, and not to even say how optimistic they are when it comes to the life and how long they're going to be living. When it comes to creating successful business exit, these optimistic and ill-informed assumptions are blinding the business owner to how wide the actual gap is, handicapping their ability to appreciate how long it takes to bridge the gap, and it's directly leading you, business owner, Mr. Business Owner, to your failure. Optimism, unfortunately, we know optimism is good, fortunately, but unfortunately, when it comes to the business owner, most of the business owner, I would say 99.99%, are overly optimistic. Optimism and lack of knowledge give owners license to postpone taking the actions necessary to create the outcome they desire, until they gain knowledge that where they think they are is far distant from where they are, and that where they need to be is even further than where they think they need to be. Nothing will happen. They won't engage into the process of business exit planning. So how can you overcome, Mr. Business Owner? How can you overcome these misconceptions? You must consistently and continually educate yourself when it comes to the business, how the stuff works, what does it take, and so on and so forth. And for us as a business exit planners, we need to constantly work on educating you on that topic. We need to reach out to you, and we need to inform you about all the stuff that you need to know when it comes to the process of business exit planning. And then still, you will come out of this pretty much not complete. Why? Because you still have that final step to take, Mr. Business Owner, and that is to start with your business exit planning. Okay, I'm going to end the topic of financial analysis gap or gap analysis and cash flow. I'm going to point you out to our website, businessexitplanninghawaii.com, businessexitplanninghawaii.com. 695-2102, 695-2102 is our phone number. Don't be a stranger. Give us a call. We don't bite. We can definitely spend some time talking to you and figure out where you are, where you want to be. 808-695-2102. Okay, like I promised earlier, and as you already know, today is a business exit planning edition of Hawaii Money Resource topic, exit planning and a cash flow. In the second step of a business exit planning, that's pretty much what we're talking about today, is the second step of the 7-step process of business exit planning. We talk about a financial gap between the value of the company and your personal assets, how to analyze it. We talk about cash flow of the business, cash of the business. Now let's talk about valuation. That's something that you definitely need to do as a part of the second step process or 7-step process. And I'm going to give you 5 reasons you need to know what your business is worth. Before you join the business owners and business owners that did valuation, you need to understand what is the 5 reasons that you should do valuation of your business. Number 1, you need to establish your starting line and distance to finish. What does this mean? You need to find out where you are with the business value and where you need to be, right? Circling back to our conversation earlier when we talk about a gap. Number 2, test your exit objectives, meaning is realistic, is it achievable, is it measurable? Number 3, provide important tax information. The valuation will provide you with important tax information, give you critical litmus test. And last one, provide owners and the employees an objective basis for incentive plans. You didn't think about this one, right? But it's very important. So if you're listening and you're still not sure that your list requires rearranging, rest assured that an estimate of the value is not the full-blown opinion of value that you will need just prior to your transfer of the ownership. And the cost is about half as much as a standard opinion of value. So we're talking about a preliminary valuation right now. We're not talking about a full-blown valuation. The preliminary valuation is the basis for the later and complete valuation that will cost you maybe $250, $300 per hour, and usually suggested that accredited business valuation person or company should do it. Preliminary business valuation is also used for planning purposes only. It cannot be relied upon for tax or any other purposes. So reason number 1, establishing your starting line and distance to finish. Let's elaborate all these 5 reasons and go a little bit into detail. To create exit plans for owners, we use a 7-step process that is based on each owner's unique objective. The 3 primary objective owner sets are the date they wish to exit, the amount of cash they need from the transfer, and the choice of successor or who is going to take over that business. In the course of achieving this objective, most owners want to receive full fair value for their companies or ownership interest. Few owners are comfortable relying on averages or rules of thumb, informal or casual estimate, because these yardsticks rarely take into account variations in revenue, cash flow, location, reputation, proprietary technology, contingent liabilities, and other factors that can have a significant effect on the value of particular business. So, how else do you determine your starting point today's value without the estimate of experienced trained business valuation specialist? Or if you subscribe to the "it's not where you start, it's where you finish" school of thought, can you admit that it might be good to know how far you must go to reach your finish line? In exit planning, your finish line is the amount of cash you need from your company on the day that you sell or transfer your business. So if neither starting point nor distance to the finish interests you, ask yourself this question: do you think a sophisticated buyer will acquire your business without first determining what is it worth? Of course not. Nor should you sell transfer your business to anyone without first determining what the value is. Reason number 2, test your exit objectives. As I mentioned earlier, one of the first questions you will answer as you set your exit objective is: how much will I need from sale of my company to maintain the lifestyle? And that's not any lifestyle, but lifestyle that I want for me and my family in retirement. The companion question should be: is the business worth enough on after-tax basis, don't forget that, to support those needs? You must know these answers before you can successfully proceed down any exit path. So let's assume that you decide that your finish line or financial objective is to receive $7 million after tax from the transfer of your business interest. You also want to complete your race in 3 years. That's the timing. An estimate of value will tell you if the distance between today's value and the finish line is too great to reach in those 3 years. If a growth rate is unrealistic for your business, you must either extend your timeline or lower your financial expectations. Why don't we take our last break, sip on coffee a little bit, and wrap up today's show. We have a business exit planning edition of Hawaii Money Resource. Topic for today is exit planning and a cash flow. We are in the process of trying to convince you that figuring out preliminary business valuation is very important in overall process of business exit. My name is Marko Mijuskovic. Stay tuned. We'll be right back.
KGU.
Part of the Wall Street Business Network.
We all want to retire someday, but how will you afford it? Marko Mijuskovic here, financial advisor for Wealth Strategy Partners. Times are tough, but nothing brings comfort and security like having a financial strategy. Some financial strategies can be complicated, all those numbers and percentage points. It makes your head spin, but that's why I created an easier to understand system called Retirement Income Timeline. Let me analyze your situation using my Retirement Income Timeline, and I'll show you how you may be able to turn your money worries of today into a stress-free retirement of tomorrow. It's easy. Just call me and I'll assist you. Get your personal retirement income timeline by me, Marko Mijuskovic, today. Call 695-2102, 695-2102.
Registered representative and financial advisor of Park Avenue Securities, LLC, abbreviated PAS, 7 Hanover Square, New York, 10004. Securities products or services and advisory services are offered through PAS, a registered broker-dealer and investment advisor. 888-600-4667. PAS is a member FINRA SIPC.
Achieving personal financial success can be complicated. Marko Mijuskovic can make it simpler. That's something very good to know in a world where the wrong financial decisions can be all too costly. Marko Mijuskovic, Vice President of Wealth Strategy Partners, has been helping people in Hawaii successfully organize and plan their finances for years. Marko uses an holistic approach to help you balance your current financial obligations as well as your future concerns. And he does this while keeping things simple. Organizing your finances is serious business, but it doesn't have to be complicated. Find out how Marko can help you make smart, informed decisions about your financial future. Call him and schedule your complimentary session and tell him your story. He's there to listen. The toll-free number to call is 877-695-2102. That's 877-695-2102. 877-695-2102. Marko Mijuskovic. You're listening to Hawaii Money Resource with financial advisor Marko Mijuskovic. If you'd like to speak to Marko, either on the air or after the show, call toll-free from Oahu and the Outer Islands, 877-695-2102. That's 877-695-2102.
Welcome back. You're listening to Hawaii Money Resource. My name is Marko Mijuskovic, Senior Partner, also Certified Exit Planner at Wealth Strategy Partners. Don't forget to check us online, hawaiimoneyresource.com and businessexitplanninghawaii.com. Businessexitplanninghawaii.com is the website solely focused on business transfer or business exit. And you can find a lot of good resources there, including the stuff that I'm covering right now. That's a white paper on 5 reasons you need to know what your business is worth. We talked about earlier about the reason number 1 being establishing your starting line. By doing the preliminary evaluation, you're establishing your starting line. And also number 2 is testing your objectives. Number 3 is basis for tax planning. So if you do preliminary business valuation, you're establishing the basis for your tax planning. And what does that mean? So as you consider various exit paths, meaning sell to the third party or transfer to insiders, understand that each path has different tax implication. Without appropriate tax planning, taxes can take a huge bite out of your sale proceed. Don't forget taxes. IRS is sitting in a corner, patiently waiting waiting to collect that capital gains after you sell that business. So given that the tax mitigation strategies often take years to implement, it's critical that you start planning well before you exit and that you use an accurate estimate of value. For example, in a transfer to key employees, a common transfer technique is to initially transfer minority interest at the discounted value using a rule of thumb. Valuation to support minority discount simply will not fly when the IRS asks you to justify the discount. You must depend on the valuation of an independent valuation specialist who is able and is willing to defend the valuation before the IRS. So when you're picking up the valuation specialist that can help you with the process of valuation, make sure that they have experience with IRS rules, courts, representing client in the court in front of the IRS and trying to justify and reason out with the IRS why the value is so low. Okay, number 4 reason is litmus test. Owner effort, target buyer, buy and sell agreement. Suppose that an owner is ready to leave the business if that exit yields financial security. The owner must calculate the amount of cash needed as to assure financial security and subtract it from the value of the business today. The resulting gap amount, and we talked about a gap analysis earlier, tells the owner how much value he or she needs to create to meet her objectives, as well as where he or she needs to concentrate the time and effort. Instead of growing value of your business, dedication to goal enables many owners to exit sooner with the same amount of after-tax cash than owners who do little or no planning. Targeted buyer it surprises many owners to learn that business value is relative, not fixed. It can vary based on the owner's choice of successor as well as one of the conditions under which a transfer is made. For example, appropriate business value for a third-party sale may be significantly higher than the established for a transfer, of the same business to key employees over time or gift to the kids. Buy and sell. Value is not only relative based on successor choice, its fluctuates depend on how the owner plans to use the valuation. In co-owned companies, unless owners periodically update value established for the buy and sell agreement, one owner may receive too much or too little, while the other may pay too much or too little. Outdated valuation often results in litigation as the slighted owner goes to court. Reason number 5 why you want to do the preliminary valuation right now is provide the owners an objective basis for incentive plans. Very important. Nothing to do but everything to do with the exit planning. An important part to any exit plan is to grow business value, right? And who will do that? Well, your employees will help you with it. Whether you contemplate a transfer to insiders or sell to outsiders, you must involved and motivate and keep your management and key employees. To do that, owner use incentive programs that both motivates and handcuff employees to a company. These plans are typically based on formulas, and the most successful of these incentive programs use formulas that link the size of bonus to growth in the business value. Participating employees are justifiably interested in knowing how the business value was established, how it's measured, and whether the value is fair. Relying on the outside appraiser is often the best way to dispel management key employee concerns. If you are considering transfer to key employees, do you expect your employees to accept an unsupported valuation? Understand that they likely have little sense for what the business is worth or how value should be determined. Even though you might decide to sell the business to low value, employees may not consider the value to be low. Anticipate these concerns and use independent valuation to ally with them. Wow. So much truth. Pretty much reading this and trying to project it and reproject it to you is just like is going hand in hand what we see out there. We have some ants going on. It's what we see in the office dealing with the business owners and what the concerns are and what is it that they're facing, especially what I just mentioned when I said that your value, even though you think it's low for your business, future business owner or someone, a key employee that is buying your business maybe is not too low. So the cost is one of the cost of an estimate of the value can vary. And that's usually the hurdle that business owners don't want to go over because they really don't know how much it costs. And the cost can vary. Depends on the size of the company and what is actually evaluated. It can go from $0 to $25,000. I will say here locally in Hawaii, probably tops you will pay probably 10 grand. Depends. Okay? And depends who performs the valuation. If you're using free online valuation softwares, transaction intermediaries, non-certified advisors, or certified business appraisers. The cost for an estimate of value can also reflect the complexity of the business, region of the country where your company does the business with. For a normal business with a 10 million or so in revenue, valuation typically costs 5 to 15. I'll say 5 to 10. An estimate of value costs 60 to 75% of that amount. When the value calculation is upgraded, usually just prior to the sale, the evaluator will charge an additional 25%. Why? Because they already did valuation in the past. All they're doing plugging the new numbers. So you need to be aware of that as well. You're not paying for a full-on valuation. It's just updated version. The true cost came out earlier. With all the experts clamoring for your business, who should you use? Look for a credentialed valuation expert unless you own a very small business that has no proprietary technology such as small retail store, franchise, restaurant, or service business with only few employees. Common certification designations are CVA, and that stands for Certified Valuation Analyst, ASA, American Society of Appraisers, ABV, what stands for Accredited in Business Valuation, and CBA, Certified Business Appraiser. I think we shared a lot of information today. We did have a business exit planning edition of Hawaii Money Resource. Topic was exit planning and the cash flow. Make sure you download the podcast as soon as it's available. Make sure you read and read and read everything you can find on a business exit planning. And don't forget to call us at 808-695-2102. My name is Marko Mijuskovic. I'm a senior partner, also certified exit planner at Wealth Strategy Partners. Give us a call. Let's talk. 695-2102. Stay tuned. We'll be right back next week.
The Living Balance Sheet and the Living Balance Sheet logo are registered service marks of the Guardian Life Insurance Company of America, New York, New York. The graphics and text used herein are the exclusive property of Guardian and protected under U.S. and international copyright laws. Copyright 2005 to 2011. The Guardian Life Insurance Company of America. This show is for informational purposes only. Individual risk tolerance and investment objectives must be reviewed prior to making any specific recommendations. Marko Mijuskovic is a registered representative and financial advisor for Park Avenue Securities, LLC, 7 Hanover Square, New York, New York, 10004. Securities products, services, and advisory services are offered through Park Avenue Securities, a registered broker-dealer and investment advisor. 888-600-4667. Financial representative, the Guardian Life Insurance Company of America, New York, New York. Park Avenue Securities is an indirect, wholly owned subsidiary of the Guardian Life Insurance Company of America. Wealth Strategy Partners is not an affiliate or subsidiary of Park Avenue Securities or the Guardian Life Insurance Company of America. Park Avenue Securities is a member FINRA SIPC.